So, sorry, to answer your question. So the value of that bond will fluctuate. If you hold it to maturity, you're going to get back your original investment. So it doesn't matter what happens. If you decide you need that money earlier, then you're going to be subject to whatever the prevailing price is in the market, just like a stock. So if you buy Facebook at 50, you need the money 2 years from now, it's at 70, you sell it, you made $20. A bond is going to work the same way. But you always have the option to hold it to maturity, and always, as long as it doesn't default, meaning that the entity that issued it can't pay it back, you're going to get your original money back. So when we talk to investors about bond investing, a lot of times we're talking about holding those bonds to maturity because it gives you stability and it gives you the option to not worry about price fluctuations as much. That's the thing. I mean, with so many bonds that are available, every individual bond has an interest rate or a yield. Interest rate and yield are used interchangeably. And so the basis for most of what we do in the bond world is based on U.S. Treasury bonds. So that's what we pay attention to for the most part. And most instruments trade relative to what U.S. Treasury bonds are doing. And so to look at relative value or how the market is moving, the market tends to be looked at as the Treasury bond market. So that's what you see reported on the news. That's what you see on CNBC. You unfortunately have Jim Cramer on CNBC yelling at you about trading and selling and throwing stuffed animals at you. And I encourage you not to listen to Jim Cramer because he's trying to turn everyone into a trader. And we're trying to turn you into an investor. So, but that is essentially how we're trying to look at it. But each individual bond is going to have its own specific interest rate. So let's talk about the difference between an interest rate or a yield and a bond's coupon. Okay, those are two different things. So when you buy a bond, there is typically a fixed rate associated with that bond. That is the rate of interest that you receive. So that is called the coupon payment, and that is typically fixed. Sometimes it's not. I like to call the bond market the not quite fixed income market because most bonds are fixed. So that, again, that is a contractual obligation that issuer has to pay you. That is different from the yield or the interest rate. The yield is the return you will get when you hold that bond to maturity. So if we think about how we buy bonds, you might buy them at what's called a discount. So a little bit cheaper than where it was issued would be a discount bond. If you buy a bond at a discount and it goes up in price because it has to mature at a certain level and pay you back your original money, that's going to be reflected in the yield. So a bond you buy at a discount is going to have a higher interest rate, higher yield than a bond that's priced at its par value. So we're getting a little into the weeds, and I don't want to get too far into that, but this is a great question because the difference between a coupon and an interest rate is an important one. And we'll cover a little bit more on that front. But so just because a bond is at a discount doesn't necessarily mean it's cheap. And that's a hard, again, it's getting a little bit into the weeds, but just because it's below its par value, it's typically for a reason. Either there's more risk. If we're talking about high yield bonds, it might be that there's more of a risk that that company is going to not be able to pay your money back, so it trades at a lower price. Or it might be that its coupon is lower than what's out there on the marketplace. So we used a 5% bond as an example. Let's say bonds that are similar to that particular issue are coming to the market with 6%. Our bond is only 5%. So we're not getting as much income. Therefore, the value of that bond is less. That's what the price is less because there's not as much income. So we can analyze bonds mathematically, and it's kind of a beautiful thing in that way, in that you've got that beginning and end point and interest rates in between. And we can use models to figure out what that prevailing price should be based on where interest rates are in the market.